All right, guys, my name is John Wald. I am with Primary Residential Mortgage. I am here to teach you guys about financing. Financing one, it is not going to be a lecture. It's not going to be anything other than kind of a discussion. And I'm happy to kind of just give you a breakdown of what goes into the whole home buying process on the lending end of things and figure out exactly how we can help you, help your clients understand the process better. So let's start with, how many people have bought a house before? Awesome. And how was the home buying process with that in terms of the mortgage end?
From my end, it was pretty simple.
That's good. So it's 50-50. Some people think the mortgage process was painful. They thought it was, being financially probed, essentially. Not necessarily the most enjoyable process, but certainly something that is necessary in terms of getting things going. So what I like to do is when I bought my first house, it was almost 20 years ago. And when I did it, I met with the mortgage guy. The mortgage guy said, sign there, date there, date there, date there, sign there. And I did exactly what he told me to do. When I did that, I got my first mortgage statement 30 days or so later. And the payment that I thought it was going to be turned out to be a lot more than what it actually was. I hated the entire process. So when I got into this business 17 years ago, I created this booklet that I want to go over with everybody so you could see what goes into the whole process in very simple and easy terms. So let's kind of go through this little booklet here and we'll answer any questions that you guys got. So, let me see if I can zoom out. Can everybody see that clearly? Awesome. All right, so when buying a house, right, we got three things that we look at in terms of a lender. And the three things that we look at are, figure out how to open this up. Sorry about this. Full disclosure, I don't really ever use Google. There we go. That's better, right? All right, so when we're talking to a buyer, right, about what goes into getting a mortgage, there's three things that we look at. And the three things are credit, loan to value ratio, and debt to total income. So in a perfect world, a borrower is going to have a 760 credit score or greater. Look, not all borrowers have 760 credit score. Not all people have 760 credit score. So really the lowest credit score that you want to have with a conventional conforming loan is a 620. The lowest that you want to have with a FHA mortgage is going to be 580, okay? So when we pull a borrower's credit, we're looking at your credit score, and we're also looking at what you have on your minimum monthly debts. We're looking at your credit cards, your student loans, your car payments, anything that is reflected on your credit report that you use to maintain that credit score. We don't care if you pay your credit card off every single month, right? That's fantastic if you do. But we just look at the minimum monthly payment. So we look at, again, you may have $25 a month on your credit card. That's all we look at. You may have a student loan payment of $100 a month. You may have a car payment of $250 a month. That's what we look at when we pull your credit score and your minimum monthly debts. Loan to value ratio is calculated by taking your loan amount and dividing it by your purchase price. So if you were to say, hey, John, I want to buy a $100,000 house, right? And in order for me to buy a $100,000 house, I want to borrow $90,000. So essentially what you're doing is borrowing 90% of the home's value, and you're putting down as a down payment 10%. So you're borrowing $90,000 on a $100,000 house. you're essentially putting down $10,000, which is 10% in that case. So the part that impacts your loan to value ratio is your down payment. The third piece of the pie that we use when we're calculating somebody to make sure that they can qualify, right, is your total monthly debt, is your debt to total income ratio. Debt to total income ratio is calculated by taking your total monthly debt plus your new mortgage payment, dividing it by your gross monthly income, and then you get what's called your debt to total income ratio. So if a buyer makes $1,000 a month in their gross income, $12,000 a year, and they have, I don't know, $100 a month in credit cards and car loans, right? What we're doing is taking the total $100 here, adding it to the total monthly debt, plus the new mortgage payment, dividing it by their gross monthly income. We don't want to see that a borrower's debt to total income ratio exceed 45% of their gross monthly income. Does that make sense to everybody? Let's see here. And then, all right, we got some more people coming in here at this. So, and again, for those that just showed up, that I'm John Wald with Primary Residential Mortgage, and I'm one of the preferred lenders here with my guys Dan and Hunter, who you probably see out in the hallway out there quite often. They're always here to help you with any mortgage related questions. I want this class to be interactive. I know it's certainly kind of hard interactive when everybody's over Zoom. So if you got a question, please just unmute yourself and kind of ask it, right? So let's talk about the four types of mortgages that are out there, right? You have VA, USDA, FHA, and conventional. Those are the four types of mortgages that are out there. Every lender offers these four types of mortgages. The two most common types of mortgages are FHA and conventional. But let me just touch on USDA and VA for a hot second. So a USDA loan is a rural housing loan, meaning if you're going to get a USDA loan, you got to be in a rural area, you know, kind of farmland-esque, or the county. USDA loan is 100% financing, which is fantastic. But with that product, you have to have a certain income limitation and a geographical location. So just because you're getting a USDA loan in the county, your neighbor's house, you might be eligible for a USDA loan, but your person across the street may not be eligible for a USDA loan. USDA loans are very geographically specific on where they offer loans for. A VA loan is the best type of mortgage out there, right? A VA loan is only eligible for veterans and those that did the proper amount of service. A VA loan is 100% financing, no monthly mortgage insurance premium, and typically extremely competitive rates. And the seller has the ability to pay all the closing costs, right? So this is a fantastic product for any veteran that is out there. You know, there's a lot of sellers that have this kind of fake sense of insecurity about a VA loan, where they think a VA loan is not going to be a good loan for them to use when the buyer's purchasing the house. That's not true. A VA loan is a fantastic product. So if you're a listing agent or buyer's agent and working with a VA loan, you just hit the jackpot. And also you're helping out a veteran, which is greatly appreciated. Let's talk about FHA and conventional mortgages, okay? So an FHA loan says that you have to put down a minimum of 3.5%. The seller does have the ability to contribute up to 6% of the sales price towards closing costs on a FHA loan. It is rare in this market to get a seller to contribute up to 6% of the sales price, right? But at the same point, you do have the ability to get that offered. The only downside with the FHA mortgage is that you have upfront mortgage insurance premium, which is rolled into the loan, and you have monthly mortgage insurance premium, which is paid on a monthly basis. Years ago, mortgage insurance premium with an FHA loan would go away. Nowadays, FHA will not allow you to get the mortgage insurance to go away, okay? So is everybody familiar with an FHA loan?
Yeah, I have a question about something you just said.
Yeah, please.
So my understanding, and I'm probably wrong on this, is that when you reach up to, I guess it would be 20% of paying down your mortgage, then the PMI would go away. Is that not correct on the FHA, or how does that work?
That's a great question. So it is not correct with an FHA mortgage. It was correct with an FHA mortgage years ago. I want to say it was 2006 and beyond, or 2008 beyond, you don't have the ability to get rid of the PMI.
Wow. I mean, unless
So,
you refinance, can you refinance out of it?
absolutely. So you could refinance to a conventional product. Now let me also say this, with an FHA mortgage, you do have the ability, sorry, I'm trying to find where everybody is on this. You do have the ability, if you did a 15-year mortgage, the mortgage insurance will go away, okay, on an FHA mortgage. But if you did a standard 30-year mortgage, the mortgage insurance will not go away.
Got it. Thank you.
So, and look, FHA is great. Like, FHA is really an awesome loan, and I've done 2 FHA loans for my own personal use, right? FHA allows you at a higher, what's called debt to total income ratio, like we talked about. Conventional conforming typically has a hard stop at 50, period. Well, it doesn't typically, it has a hard stop at 50%, period, end of story. FHA will allow you higher than 50% of your gross monthly income as your monthly payment, with extenuating circumstances. In some cases, I've gotten an FHA loan approved as high as 58% when they had extenuating circumstances.
Wow.
So an FHA loan is a great product with knowing that you have the ability to kind of go with the lower credit score and go with a higher debt to total income ratio. And I always tell people an FHA loan is not a loan that you want to be in forever. An FHA loan is a loan that you're going to be in for a little while, and then you're going to want to look to refinance a conventional product. So the other thing with an FHA loan is an FHA loan is you're only eligible for an FHA loan if you, as an owner occupant buyer, right? So you can't use this as an investment property and only put down 3.5%. Now you can buy the property with an FHA mortgage and move out of the property and then turn it into a rental property, and nobody's going to penalize you for that. But your intent at the time of signing the paperwork of buying the home was that it will be a primary residence. Does that all make sense?
Yes.
Cool. Dan, how do I see people on here?
The Zoom link on the bottom, on the bottom, icon. I think it's.
I mean, it doesn't matter. All right, so
Where it says talking.
there we go. All right, perfect. So what I want to talk about next is the conventional product. Okay, so conventional conforming loan is an awesome product. Again, you have the ability to put down on a conventional conforming product as little as 3% of the sales price. All right. So you could buy a house, $100,000 house, and only put down $3,000. Now you also have closing costs on top of that, but with a conventional loan, you could put down as little as 3%. In order to put down 3%, you have to be a first-time home buyer, and you have to buy it as a primary residence. After that, you could put down 5%, 10%, 15%, 20%, 30%. You could put down whatever you want, but you will have mortgage insurance on a conventional conforming product. But the mortgage insurance on a conventional conforming product will go away with a conventional loan once you have 20% equity in the property. Okay. So to Nisha's question earlier, is mortgage insurance will be dropped on a conventional product, where on an FHA product, no matter your equity position, it will never fall off. Okay. When you put down 20% on a conventional conforming loan, you don't have mortgage insurance. But a lot of people will come to us, and say, hey, I want to buy a house now, but I can't because I don't have 20% to put down. That's not true, right? It is beaten into people's heads that you need to put down 20%. It's not the case, right? With a conventional conforming loan, you could put down as little as 3%. It's best if you put down 5 or 10%, okay? Because on a conventional conforming loan, mortgage insurance is set by your credit score and your down payment. So the higher the credit score and the more money you put down, the cheaper the private mortgage insurance is. On an FHA loan, mortgage insurance is set across the board, no matter what your credit score is. or really your down payment, mortgage insurance is basically the same because it's a government insured loan. And the government says, heck, everybody's equal, everybody's getting the same mortgage insurance premium. Well, conventional conforming loans are sold on the secondary market and says everything is risk-based. And if you have a higher credit score than me, then your mortgage insurance is going to be much cheaper than my mortgage insurance with a conventional conforming loan. So, the key is, right, and I don't expect agents to understand every aspect of lending. And you shouldn't, right? Because I don't understand every aspect of the contract or what you guys do. But I do understand enough to scratch the surface. So it's one of those things that you guys want to understand enough to scratch the surface. But your response to any time a buyer has a question, a great question, I need you to talk to John, Dan, or Hunter, right? And I need you to kind of just work out the details with that. That's their league, right? So conventional conforming loans, FHA loans. The other thing with a conventional conforming loan, you could buy an investment property and use a conventional conforming loan. But in order to buy an investment property and use it as a conventional conforming loan, you have to put down at least 15%. Okay. You cannot do it with an FHA mortgage, meaning you have to occupy that property for primary residence at the time of settlement. Does all this kind of make sense? I know I just jammed a bunch at you. Yep, please.
So what would be the difference for a home buyer looking at an FHA with 3.5% down and then the conventional conforming with 3% down? Would that be based on like their credit score? So if their credit score is lower, you would drive them towards FHA versus conventional?
Absolutely. So, and that's a great question, right? So the conventional conforming product, if you have a higher credit score, and let's say they have the same amount of money to put down, 3.5% or 5%, on a conventional conforming product, if they have a higher credit score, then I am, or my team and I will probably say, look, in terms of payment wise, it's probably going to be more advantageous for you to go with a conventional loan versus go with an FHA mortgage. Because the mortgage insurance with FHA is set, mortgage insurance with conventional is dependent upon your credit score and down payment. So.
The mortgage insurance, I'm not sure if you've done this.
Yeah. Go for it.
The mortgage insurance, that's to cover in case you can't afford the loan, it's some situation that you can't make your payments and default or something like that.
So mortgage insurance does nothing. And so the question was, what does mortgage insurance do, right? Mortgage insurance does nothing for the buyer other than allows them to buy the house with putting down less than 20%. So years ago, mortgage insurance didn't exist. And years ago, everybody had to put down 20%. Nowadays, mortgage insurance is there for the buyer to pay so that they could put down less than 20%, and it protects us as the lender, God forbid they default. Mortgage insurance is not going to cover you in case your roof gets blown off, right? That's homeowner's insurance. But mortgage insurance is there to allow you to put down less than 20%. So that's the advantage of mortgage insurance.
So are you essentially making up the difference in down payment by paying that insurance until you hit the 20%? Like paying it over time versus a lump sum?
No, you're not. That's a great question. So mortgage insurance too is like when you amortize mortgage insurance. Like I just did an estimate for a client. It's a $525,000 house. They're putting down 5%. They have really good credit, and I just did the mortgage insurance estimate, and the mortgage insurance is only $70 a month.
Really? Wow.
Yeah, they have really good credit. They're putting down 5%. It's only $71 a month. Now, mortgage insurance will fall off in that case if they pay on the regular schedule. It will fall off on about year 9. So if we take, I don't think I have my phone with me, but if we take $71 and times it by 9 years, that's going to be a lot less than putting the extra 15% down. Again, the mortgage insurance is there just to protect us in the event that the lender screws up. How much is it?
$639.
Yeah.
$639.
600. It would time. Was it 70 times 9 years? Yeah. So it's nothing, right? And the other thing with mortgage insurance, you have the ability to pay it on a monthly basis, and you have the ability to buy it out. So mortgage insurance is a with a mortgage insurance, you don't need to just pay it on a monthly basis. The mortgage insurance buyout may be $2,000 to buy it out and avoid having to pay that $71 a month. So you have some options with mortgage insurance, but it's really, again, it's just one of those things that you kind of want to hash out with the lender. And the question I always get to is, can I buy out the mortgage insurance after I've been in the home? Meaning if I'm paying the $71 a month and all of a sudden now I have an extra $2,000, can I spend that $2,000 to buy out the mortgage insurance after the fact? No, you cannot. You have to decide to buy mortgage insurance out before settlement.
Okay. And may I ask, I'm sorry for all the questions. May I ask
The
one
more
more?
the questions,
So you said for FHA, the mortgage insurance was set, right? So it's the same for everybody across the board. Does that number change? And if so, what is it driven by? Is it the cost of living increase? Like, does the government determine based over time is going to increase? Does it ever decrease? Like, what drives that?
so mortgage insurance on an FHA loan is dictated by the government, right? And right now, on the monthly basis, it's 0.85% of your loan amount divided by 12. So yes, it has changed, and it has changed over the years. The government is the one that uses that, dictates that. So I don't anticipate it changing very much, anytime soon. But it is something that, does happen periodically.
So it doesn't change like interest rates, right?
Oh, no, thank God. Yeah.
Okay.
So. And then the other question too, is I always get is like, what dictates interest rates? That's a good question, right? So you just talked about interest rates. Interest rates are like stocks and bonds, right? So an interest rate, is dictated by the mortgage-backed securities market, and an interest rate is set by, basically the market. So you can't buy Apple stock for $15 a share right now. And if you went to your broker and said, I want to buy Apple stock for $15 a share, they're going to laugh at you, right? Because you're buying what the market's predicting or giving. Right now, the market is higher interest rates. Right now, rates are 5.5, right? It's not pretty compared to where it was a while ago, but historically, it's still really low. And you've got to lock in to an interest rate. But locking into an interest rate is really when you find a house is the best time to lock into an interest rate. We do have a product that allows you to lock into an interest rate before finding a house, but it's kind of silly to do that because you don't know how long you need the term to be locked for. So that's another topic that I could cover. Let's talk about closing costs, because a lot of people don't understand closing costs. And closing costs are broken into 4 different parts, right? So when you're buying a house, the customer or the client is like, hey, cool, I'm excited to buy the house. I got 5% to put down on a $200,000 house. I got my $10,000. Let's roll. Let's find a house, right? I say, great. But do you have the other about 4 to 4.5% that you need for down payment for closing costs on top of the money that you got for down payment? And most clients sit there and scratch their heads like, whoa, no, I don't, right? I don't know what that is. So let's explain what closing cost is, so that everybody kind of understands closing costs and that we have a clear picture of what it is. Because in today's market, unfortunately, the buyer's not getting the seller to pick up the closing costs, right? The buyer has to prepare themselves for not only the down payment, but also the closing costs. So when buying a home, there's 4 parts: lender, title, state, and your escrows. I'm going to base this scenario off of Baltimore City, okay? So when buying a house, there's lender-specific charges. Our transactional cost is $16.95, right? That's our transactional cost. That's what it costs to process, underwrite, and close the file. All these fees are paid at the time of settlement, okay? Other than the appraisal. The appraisal fee is the only out-of-pocket expense that a buyer must pick up before settlement, and the appraisal fee is on average $575, okay? Typically, a realtor admin fee is $495. That's what obviously the brokerage charges in order to keep the paperwork on file, etc. So that's lender and realtor portion of closing costs. The next portion of closing costs are title company charges. A title company is there to verify that you're buying the house from the rightful owner, kind of an important job. And they're typically going to charge you around $1,300 for their transactional costs, $1,300 to $1,500. Title insurance is there to protect you as the buyer in the event that the title company messed up. And again, these are all one-time fees. And then the owner's title insurance is there to protect you in case the buyer, the title company messed up. And lender's title insurance is there to protect us in the event that the title company messed up. So that's about a total of about 0.5% roughly in just title insurance that the buyer has to pay. The next is city fees. So we're basing this on Baltimore City, right? Because we're in Maryland here. Baltimore City happens to be the highest of all the counties to buy a property in. All right. So every county in Maryland, every county in every state in the United States has their own specific closing cost transactions or fees rather. So transfer tax in Baltimore City is 1.5% of the sales price. Recordation tax is 1%, and the state tax anywhere in the state of Maryland that you pay, that you live, you have to pay state tax. The state tax is 0.5%. So these total fees come to around 3% of the sales price. It is split between buyer and seller typically. So instead of paying 3%, the buyer is only paying 1.5%, and that's split between the buyer and seller. So instead of paying the 3%, they're paying the 1.5%. And if you're a first-time home buyer in the state of Maryland, no matter where you're buying in the state, your portion of the state tax is waived. So instead of paying 1.5% in Baltimore City, now you're only paying 1.25%, which is a nice little savings. That all makes sense to everybody? And what's great is in terms of the state portion of the tax, you could have owned a property in 49 other states, but if it's your first property as your primary residence in Maryland, then your portion of the state tax is waived. The last part of closing costs are known as your escrows. And the escrows are your taxes and insurance. So when a buyer comes to me and says, hey, I want my payment to be $2,000 a month, right? What they're typically talking about is their principal, interest, taxes, and insurance payment, their PITI payment. Your principal and interest is based upon your loan amount, your interest rate, and your term. The longer the term, the cheaper the payment, okay? So the second part of the payment is your taxes and insurance. Your taxes and insurance are known as your escrow account. Your taxes and insurance are, your taxes are based on what the county and the state or the county and the city are charging you for property taxes, and your insurance is based upon the homeowner's insurance that you're getting through your own provider. We, at the time of settlement, we're going to collect for 10 months worth of property taxes. We're also going to collect for 14 months to 15 months of homeowner's insurance. We collect for 10 months of property taxes because we are going to pay the seller back for paying taxes in advance, right? So taxes are due July 1st and December 31st. So we're going to go ahead and pay the seller back for paying taxes in advance if we're settling on June 8th, for example, today. So they pay their taxes until on December 31st, all the way until July 1st, and you prorate them for paying taxes in advance. And then we need to escrow for the future. So we're always collecting 10 months worth of taxes. We're also going to collect for an additional escrow account. So we're going to pay the seller back for paying taxes in advance. And we're also, so it's about 6 months, and then we're going to collect for about 3 to 4 months of escrows. Your last part is your homeowner's insurance. The homeowner's insurance, you got to pay for 1 year up front and then collect for an additional 3 months at the time of settlement. My rule of thumb, all of these fees on average will come to 4.5% on a $250,000 house or greater in Baltimore City. In Baltimore County, it's going to be closer to 4 and 4 1/8, okay, of all of these fees. The lower priced homes, that percentage is going to be higher because it doesn't matter if you're buying $1 million house or a $10,000 house. Our fees are the exact same, such as your fees are the exact same. So that impacts the percentage. Is all that kind of clear?
Yes, I've heard of something before called an origination fee, which is like 1% of the loan. What does that fall in, or is that something that's not always applicable?
I mean, that depends on the lender. Like we charge a flat $1,695, right? That's our transactional cost. The other lenders may charge a flat origination fee of 1% of the loan amount. You know, it really depends on the lender and their kind of policy and pricing.
Got it.
So now this is exclusive of any points that a buyer would pay, right? A point is a percent of the loan amount. So in theory, a buyer could get any interest rate they want, right? If the rate's right now 5.5%, and a buyer comes to me and says, I really want 4.5%. So great, well, you could get that rate, right? You could get whatever rate you want, but you have to be willing to pay for it. And a point or points are fees that a buyer is paying in order to achieve the rate that they want to get. So Rocket Mortgage, and I'm not here to kind of just poo-poo our competition, but I hate Rocket Mortgage because they have such a speaker, right? They're the biggest marketer in the nation in terms of mortgages. If you go on Rocket Mortgage's website right now, you'll see their interest rate is going to be, let's just say 5.25%, which might be lower than the interest rate that I quoted you and your client of 5.5. But what you don't see until you click the fine print is that they're charging 2.25% or points to get that lower rate. A consumer, an uneducated consumer, will always go for the lower rate without understanding points. So your job as a realtor is to say, look, you got to understand points. It's not just about the rate. It's about the whole picture, right? A point is 1% of the loan amount. So if a buyer is borrowing $200,000 from us and they're paying 1 point, then they're paying $2,000 to buy that interest rate down. And they call it points rather than percentages because your mind is just like, oh, it's just a point. But if they said, hey, you're going to pay 2% to buy that interest rate down, then you're like, whoa, 2%. You know, what's 2%? Oh, it's $4,000. I don't feel comfortable with that. But when you just say point, they're like, oh, it's just a point, right? So it's very important to understand those details. And that's why, like, look, local. And I say this and I repeat this because, like, there's three rules of real estate: location, right? When you guys are taught into real estate class, that's all people want is their location, right? Location for the schools, location to the city, location to the grocery store, etc. When you're working with a mortgage lender, you need to work with somebody that is local, that's accessible, and knows the terms and conditions of each city and county. Okay. So just kind of keep that in mind. And a lot of people just want to click button, get a mortgage, and it's not that easy.
You said a point is how much of the loan amount?
A point is 1 point equals 1% of the loan amount.
Okay, and that's the one, so basically 1% they have to pay at closing as opposed to.
Yeah. So, and 1%, like the question I always get is like, oh, cool. Like my interest rate's 5.5%. I'll just pay 5.5 points to get my rate down to 0. No, because 1 point or 1 point doesn't equate to 1% of the interest rate. So, like, for example, like you could pay 1 point, and 1 point might bring your rate from 5.5 to 5.125 or 5.25, 5.25%. 1 point doesn't mean 1 full percent on the interest rate. So a lot of consumers don't really see that. And like, I feel like the generation of home buyers don't want to talk to people, right? Some people are like, I'll just go online, I'll click a few buttons, I'll get a mortgage, I'm done, right? No, right? You gotta be, you really just gotta be like, stop, don't do that. You gotta talk to somebody local, not only for service, not only for understanding of the area, but really at the end of the day, that person's in Detroit, which is where Rocket's based, is, you know, they have no ties to me as the realtor. They have no ties to the lender, to the area or the title company. And, you know, they're just going to slam your client with fees that don't need to be there. And your client doesn't know that because most cases they're first time home buyers and they just see this, you know, the Super Bowl commercial with the Barbie dream house, you know, that Rocket produced. So kind of got off topic, but I hope that was helpful. So we could go into what is needed for a loan, but like, what are some of your guys' struggles, questions, anything like that? Like, I want this to be helpful for you. So what are some things that you guys got questions for lenders?
I have a question in regards to this, and it's funny because I actually just got off the phone with a client not too long ago. So for instance, this client that I'm working with currently, she's a realtor, but she's based out of Virginia, but she's looking to buy an investment property here in Baltimore. And I was her loan, oh gosh, I'm sorry, somebody's calling. I was asking her because there were some issues with the lender qualifying her loan because she is a realtor, so her income is very inconsistent. So she's going to do it with her husband, but with the husband, there's a few credit issues there that they're trying to work through. So when you look at the documentation, right? So my question is, and I say, well, let's say, how do you guys look at someone in her situation where she is like a consultant or, she doesn't have a W-2, she has a 1099, and there is that inconsistency in income. How is that viewed by you guys?
So that's a good question, right? So W-2 borrower is a cookie cutter borrower, meaning they just get a straight salary of X, right? Meaning I should say salary borrower, because you could be a W-2 borrower and it's not cookie cutter. But when you're self-employed, which is what the realtor is, anybody that gets paid 1099, K1, anything of that nature, you're considered self-employed, and you need to have a 2-year history of being self-employed. In addition to having a 2-year history, you also need to make sure that you are filing your taxes appropriately, and whatever you show on your tax returns is what we're going to use. So if she grossed $100,000, but then wrote off $90,000 in expenses because she wanted to limit her taxable income, then in that case, we can only use the $10,000 as her income. We cannot go off of gross. We have to go off of adjusted gross income, right? The net income on the bottom. Also need to make sure that there's a consistent history, and we can take a decline in the income, meaning if she made $100,000, in your adjusted gross income on 1 year, and then made $85,000 in adjusted gross income the next year, we can take the adjusted gross income decline as long as it doesn't exceed 20% from year over year. So, makes sense?
Yeah, isn't there an instance where, like with a certain credit score, you only need that 1 year of income and they can do a conventional loan?
So the question was, in a case where a borrower is self-employed, can you get away with using just the most recent filed tax return year? And the answer is yes, but it doesn't necessarily have to do with credit score. It has to do with the buyer or the business had to have been in existence for at least 5 years. So in the case where, like, let's say this realtor, had a banner year last year, and she was a realtor for, let's say, 15 years, and the year before that she made 20 grand, and this year she made 100 grand. Well, depending on what the findings say through underwriting, we may be able to only show 1 year of tax returns, the most recent filed tax return. So, which is certainly helps some situations, right? But look, I mean, the hard part is, and I struggle a lot with this, with especially buyers that are filing tax returns around this time of year and earlier, and they want to buy a house and they're self-employed. I say, please send me your tax returns before you send it to the accountant to file it, because I just want to see if there's anything that we could add back in that's actually going to be helpful. So, because a lot of people want to be aggressive on their tax returns, and then when they come meet with us, they get upset at us. But I'm like, you made 100 grand, but you wrote off 90,000. You're only being taxed on $10,000. It's your fault. Like, unfortunately, there's nothing that we could do, right? You can't have your cake and eat it too. So, and another part that you mentioned about that particular situation is you talked about 2 borrowers, and I think this is important for us to talk about, right? You talked about 2 borrowers, right? So there's 3, when we pull somebody's credit, there's 3 credit bureaus: Equifax, Experian, and TransUnion. We use the middle of the 3 credit scores. So if a borrower had an 800 credit score, 742 credit score and a 741 credit score, we're going to use the 742 credit score as the factor in the mortgage. When there's two borrowers on the mortgage, we have to use the lower of the two borrowers' middle credit score for qualifying purposes.
Oh.
So in some cases where we'll have a situation where, like, let's pretend husband and wife are buying a house, husband may have worse credit than the wife and also have good income to support the mortgage. In some cases, we may advise the husband to be taken off the mortgage, just put the mortgage in the wife's name and put both of them on the deed. And it may yield them a lower monthly mortgage payment because we removed one person with the lower credit score. So again, our job, I always tell clients, right? Like, you guys have the fun job. The realtor has the fun job. You get to go show houses, you develop rapport, you have a good time. Well, the client's going to be paying us for the next 30 years. So if they can't set aside 45 minutes to have a conversation with us, a Zoom call, face-to-face, phone call with us, then there's something wrong, right? You need to encourage your clients to have a conversation with us, meet with us, discuss this, and develop a plan. I consider myself a financial planner for your house. I don't consider myself just a mortgage guy.
I had a question.
Yep.
I just walked back in, so I kind of didn't get the full story, but saying about the husband and wife take one out and put it on a deed. So when you do that, both of their income still included in the loan, is just the one, right? So if they was to go in together and put it on a deed, if both of their income be combined and get a higher approval amount.
So if the only way, so the question was, in a situation where you got to remove a husband or a wife, but just keeping one of them on, keeping both of them on the deed, but removing one from the mortgage, can we use the income of both people that are on the deed? And the answer is no. The answer is you have to, for who's ever on the mortgage is the people that you use to qualify for the mortgage loan. But, you know, in the case that I just mentioned, the borrower would qualify, the wife would qualify without the husband's income, and it would be better for their monthly payment to just put it in the wife's name and put both husband and wife on the deed.
Okay. So say if it was an instance like me, Hunter, and Dan, wanted to buy one house together without income combined, got good credit and everything, we would receive a higher approval amount because of each different income sources.
Yep. Yeah. So if you combine income and you're all on the mortgage, yes, your debt to total income or your income that we could count would be better. But you also got to consider, like, when we talk to a buyer and if they need a cosigner, right? Let's pretend young girl's buying a house and wants her dad to cosign or mom to cosign so that she can qualify for the house. Whenever I have a conversation with a client like that, I'm like, fantastic, right? We're going to get mom or dad to cosign. Not only make sure mom and dad have good income, but it's an awkward conversation, but you want to ask them about their debt situation, because just bringing somebody on that makes good money doesn't necessarily mean that it's going to solve the problem, because we have to account for their debt too. So if they've got a ton of debt, but make a good amount of income, they may not help the situation because they got too much debt that we also now need to carry. So, but look, again, every situation is unique. Every person is unique. And that's why it's very important to have a conversation with us. And the hard thing is, like, right, the internet's at our fingertips and people could get information very easily. And the problem is some of the information that people get is just junk, right? And they don't want to hear it. You know, I just had a client recently, he just got under contract, and the only reason he got under contract was because of the realtor and myself. The listing agent had 14 other offers on the house, but they knew me, they knew the realtor, and the terms were reasonable. They weren't the highest, they weren't the best terms, but they knew that the deal was going to go through, right? And I use that example because I think it's important that we tell our clients, like, guys, Rocket Mortgage, all these different companies are not the solution. The solution is a team, and the team is here that's going to help you get the house, right? You need to work with people that are local, good reputation, and will get you to closing. Because, yeah, you'll save $30 going somewhere else. But that $30, by going with some rando person on the internet, may not actually get you the house. and then you've lost your earnest money deposit, you're potentially being sued by the seller, and it's taken you 2 months to actually get a house under contract, and now you're back in the marketplace. So it's not worth it. And that's what we have to kind of relay to our clients is like, it's local, local, local. So, all right, I just went on a tangent. So anything else?
Working with investor clients.
Yep.
And they want to apply for a loan using their business entity. What would be the difference in documentation that they would need to provide in order to see if they are pre-approved?
So I will tell you this personally, we do not, our company, Primary Residential Mortgage, is only for primary resident, or only for owner occupants, right? If a buyer wants to buy a home as an LLC, a limited liability company, then they have to get a commercial loan because they're getting a limited liability company is actually the one that is accounting for the payment. But typically when you do something like that, I have an investment property, that is through an LLC, and I bought it through the LLC. I had to go to a smaller bank. The terms are not as nice. The interest rate is not as nice, and the down payment requirement was 25%. So it's sometimes better, right? If you're talking to a buyer that is like, I want to get into real estate, I want to be an investor, I would say, cool, buy the first few in your own name. You don't need to put it in an LLC, right? Because what are you concerned about? Oh, I'm concerned that the tenant's going to sue me. Do you have an insurance? Do you have proper insurance on the house? In addition to proper insurance, do you also have an umbrella policy? You guys know what an umbrella policy is for insurance? Because if you don't, and you own a house, you need to call your insurance person after we get out of here and get an umbrella policy. An umbrella policy is there to protect you as the homeowner. God forbid something happens somewhere else. So I have an umbrella policy on my house, and I think and I'm not sitting here to brag. It's $1 million umbrella policy, right? God forbid somebody hurts themselves at one of my properties. They have to go through the insurance premium, which might be $50,000 or $500,000, right? And then they have to go through the $1 million umbrella policy before they touch my personal assets. The $1 million umbrella policy that I pay for every single year, I think is $80 a year. It's nothing. So some people will be like, I want to get an LLC loan, right? Because I want it to protect myself. And my answer is, you don't necessarily need to do that on your first 1 or 2 or 3. You want to make sure you have an umbrella policy, because the umbrella policy is going to protect you as much as, not me, I shouldn't say as much. I'm not a lawyer, but the umbrella policy is going to protect you. So, and then you had one more question, I think, right?
Yes. Well, I was gonna go back to the self-employed people.
Yep.
What is profit and loss statement?
Yep.
Required to get?
Yep. Okay, so the question was, when you're working with a borrower that is self-employed or a buyer that is self-employed, what is a profit and loss statement? Why is that required? And what is it, right? Or I said that twice. A profit and loss statement is pretty simple. Like if you're self-employed, which everybody is here, you know what your Schedule C looks like on your tax returns? Your Schedule C says gross sales, expenses, which could be marketing, new computer, your business travel mileage, right? And then on the bottom, it will tell you what you grossed or what your true income was after your expenses. A profit and loss statement is the exact same thing, but it's not your tax return. So a profit and loss statement will label total income for that month or year to date, expenses, and then it will say you earned, or your gross income was 50 grand. So
I don't know if y'all know this or not, but is there a way to utilize mattress money?
So the question was, now mattress money is not necessarily a term we use here. But so the question is, if a borrower has a bunch of money in cash, can we actually use that as money for down payment and their own assets? The answer is no, okay? Because we need to be able to source where that money came from. Now, typically, when we're looking at a buyer's bank statements, we only go back 60 days, okay? So we only need to see 60 days worth of bank statements. In addition to that too, like depending on the loan type, if it's a conventional conforming loan, we only source, meaning like if I have a bank account and they ask me for my updated bank account, and let's say I make $5,000 a month, right, is my gross monthly income, 60 grand a year. And I deposited in my bank account, doing a conventional conforming loan, I deposited $2,000 in cash. Technically, we don't actually need to ask for where that $2,000 in cash came from, as long as the income or the deposit is under 50% of the borrower's monthly, gross monthly income. So if a buyer deposits $2,000 and again makes $5,000 a month, that's under the $2,500 of half of their monthly income, and we don't necessarily need to ask for that. Now, on an FHA loan or a VA loan, the guideline is different, but on a conventional loan, we don't need to ask for the income if it's under 50% of the gross monthly income. So. Any other questions? All right, we got 6 minutes, so I appreciate your guys' time. If you got anything else, please let me know. You know, we are here. I would love it. I'm going to get the roster of who came, but I don't know if I could do this here. Let's see. This is, that's my information. Let me give you guys my cell phone. If you guys want to text me, right, I will go ahead and text you guys back and connect you with my team and I, and we could go ahead and do a consultation, talk about some different things that our marketing team will do to help you qualify, or not qualify. Our marketing team will help you with your business. So my cell phone, it's a New York number because I was born and raised in Brooklyn, moved out to Westchester, then ended up, and I heard your accent, and then went here for school 20 something years ago and haven't left. But my cell phone is area code 914-629-1278. Again, 914-629-1278. And just shoot me a text with your name, your email address, your phone number, even though we'll have it. And then what I'll do is I'll save it in there, and then we can pair you guys up and hopefully start doing business. So I appreciate your time, and thank you.
Thank you.
Yeah.
Your name's John, right?
John, yep, John Wald. I should have said that. W-A-L-D. J-O-N, no H. But I've been called worse with the H, so don't worry about that.